Welcome to Tech Money Madness, your daily U.S. stock market podcast, March 30, 2026.
Yeah, and today's market is, well, it's a wildly complex puzzle right now.
It really is. Imagine trying to drive a car while you're slamming your foot on the gas pedal and the brake at the exact same time.
Right. The engine is just screaming.
Huh.
Your brake pads are smoking.
Exactly. The whole chassis feels like it's about to just shake itself apart. And welcome to today's deep dive, where that smoking car is basically the global economy.
It's a really volatile picture for anyone paying attention. If you look at the intelligence we have for today, we are basically watching opposing economic forces physically crash into each other.
Yeah, we've got a massive stack of research to get through today. We're covering huge index moves, some pretty severe inflation shocks, and, major shakeups with the tech giants.
Right, and our whole mission here is to extract the signal from the noise, right? To figure out what is actually driving your portfolio and, well, your everyday wallet.
Because that car analogy we just used, that's really not an exaggeration. The booming AI and tech sector, that's your foot slammed on the gas.
Yeah, but then you've got climbing recession odds and this incredibly sticky inflation just riding the brake hard.
So, okay, let's unpack this. If we want to understand the friction between the gas pedal and the brake, I feel like we have to start at the ground level.
Oh, absolutely. The physical economy. Because right now, the sheer cost of simply moving things around in the physical world is, well, it's causing panic all the way up to the Federal Reserve.
Let's talk about that squeeze, right? From the gas pump to the Fed. Because you, listening to this, you are feeling this every single day.
Oh, yeah. Higher oil prices aren't just hurting you when you fill up your tank anymore. It's bleeding directly into the whole service economy.
Right. Just look at the on-the-ground reality. Places like DoorDash, Lyft, even the USPS, they are actively adding new fees or just straight up reducing services.
Because they have to cope with those operational costs.
Hmm.
And this is the exact mechanism of how a temporary shock, like a spike in oil, mutates into structural inflation.
Like it gets baked in.
Exactly. When crude oil goes up, it's not just gasoline. It's the cost of moving every single physical good across the country. It's the cost of getting every service worker to their shift.
So when a platform like DoorDash or a massive network like the Postal Service adds a surcharge, they aren't just tweaking their margins.
No, they're passing that underlying friction directly onto you.
But help me understand the scale here. Because, a simple markup on a food app, say an extra $2 for your Friday night takeout, it's annoying, sure.
Yeah, nobody likes it.
Right. But how does a $2 fee on a burrito translate into Wall Street analysts actively raising their recession odds?
Well, because those microtransactions, they aggregate into massive macroeconomic data sets. And the data we have right now is running incredibly hot.
The February wholesale prices, right?
Yes, they just jumped 0.7%. That brings the annual wholesale increase up to 3.4%. And we watch wholesale closely because, it's a leading indicator.
It measures what businesses are paying before they pass the buck to you.
Exactly. So if wholesale is up 3.4% annually, it's basically baking in future pain for the consumer price index.
And the February CPI already showed a 2.4% increase year over year.
Yeah, but the true nightmare for the central bank is January's core inflation.
Right, because core strips out the volatile stuff, right, like food and energy.
Exactly. It strips those out to find the underlying trend. And that core number is just sitting there stubbornly at 3.1%.
Which brings us to a massive red flag in today's research. A major global forecasting group is now predicting a 4.2% U.S. inflation rate for this year.
Yeah, 4.2%. It's wild.
The Fed's entire mandate is to keep inflation around 2%. We are staring down the barrel of more than double their target.
And when you digest a 4.2% forecast, you immediately see why the Federal Reserve is backed into a corner right now.
Because traders are looking at this and concluding that the era of cheap money is just over.
Pretty much. There is virtually zero chance of an interest rate cut this year. None.
In fact, the probability of a rate increase by the end of 2026 has officially shifted to 52%.
Right. The market thinks it is more likely than not that your borrowing costs are going up.
Which loops right back to your car analogy from earlier.
Yeah, to cool off that 4.2% inflation, the Fed basically has to hit the brakes even harder.
Because higher rates make it more expensive for businesses to expand or for you to get a mortgage or an auto loan.
They are actively trying to slow down the velocity of money without sending the entire vehicle into a ditch.
But here's the terrifying part about that domestic inflation rate. The Fed can't just hike interest rates and magically fix it.
No, because the U.S. economy does not exist in a vacuum. A massive chunk of that price pressure is imported from overseas.
You really cannot separate the American consumer from the global supply chain.
Definitely not.
But let's look at the domestic ledger first. The U.S. deficit has officially topped $1 trillion through February alone.
Yeah, which is technically running slightly below last year's pace, but
But it's still $1 trillion in 2 months.
right, it's staggering. And meanwhile, fourth quarter GDP was revised down to a crawling 0.7% growth.
Which looks an awful lot like stagflation, doesn't it? Massive government spending, but incredibly slow economic growth.
It's the textbook definition of an economy showing deep structural cracks beneath the surface. And when you pan out and look overseas, it gets infinitely more complicated.
Okay, so let's talk about China. Their industrial profits surged 15% to start the year.
Which sounds great on paper.
Right. I want to play devil's advocate for a second.
Go
If
ahead.
the world's primary manufacturing hub is seeing profits jump 15%, shouldn't that be a huge tailwind for us?
In theory, yes.
Like, if their factories are humming, shouldn't that flood the zone with cheaper goods and actually help bring our inflation down?
Well, it would be incredible news if the global system was functioning smoothly. But that 15% bright spot is actively being suffocated by the global oil price shock we just talked about.
Oh, because China imports so much oil.
Exactly. They are the world's largest importer. So if their energy costs skyrocket just to power those factories, that 15% profit margin evaporates practically overnight.
Wow. Okay, so the input costs are just eating the gains.
Yes. And on top of that, we're operating in this environment of severe U.S.-China trade tensions.
Right, the tariffs.
Yeah, even if the Chinese industrial sector manages to produce goods cheaply, getting them into the U.S. involves this maze of tariffs and trade friction.
And tariffs just act as a universal wet blanket on global growth. I mean, they're essentially a tax paid by you, the consumer.
Exactly. And it's not just the friction between the U.S. and China. If you look over at Europe,
Oh, yeah, the European Central Bank is holding their rates steady right now.
yeah, and they took the unusual step of explicitly warning that their outlook is significantly more uncertain.
And the catalyst for that uncertainty is obviously the ongoing war in Iran,
Right, and its direct impact on global energy supplies and all those critical shipping lanes.
which just goes to show geopolitical risk is the ultimate wild card for an economist.
Oh, without a doubt. I mean, you can model out domestic consumer demand, you can project corporate earnings.
But you can't model a conflict in the Middle East that disrupts shipping and sends oil futures spiking.
No, the physical reality of war just breaks economic models entirely.
And you can see this confusion playing out in real time with Fed officials. Like, San Francisco Fed President Mary Daly openly stated that the jobs report is complicating their interest rate call.
Yeah, the data is literally pulling policymakers in opposite directions right now.
You have strong jobs keeping consumer spending, but then high inflation, geopolitical chaos, and slowing GDP growth,
It is a profound mess for the physical economy.
which makes the contrast with the digital economy absolutely jarring.
Oh, it's night and day.
Because despite this grim macro outlook, despite the 0.7% GDP growth and the shipping chaos, there is a sector of the market that is actively defying gravity.
The AI engine. And the massive tech infrastructure build-out.
Yeah. This is the foot slammed all the way down on the gas pedal.
Exactly. While the physical economy is struggling to move a barrel of oil or deliver a package affordably, the digital economy is accelerating at a breakneck pace.
The top gainers driving the market right now are Meta platforms, Amazon, and NVIDIA.
The sheer concentration of capital flowing into these specific companies is just wild.
It really is. But what jumped out at me is the valuation data. Statistically, Meta and Amazon are currently identified as the best bargains within the Magnificent Seven tech stocks.
Right, they're trading at significant discounts to their 5-year average multiples.
Let's break down what that actually means for the listener.
Sure, so a valuation multiple is essentially how much investors are willing to pay today for $1 of a company's future profit. By pointing out that Meta and Amazon are trading at a discount to their historical multiples, the data is basically telling us that relative to the last 5 years, their stock prices today are practically on clearance.
It feels like a paradox, honestly. If I look at this through a real estate analogy, investing in these tech giants right now feels like buying a luxury mansion at a steep discount, simply because the broader neighborhood looks sketchy.
Yeah, the macroeconomy being the neighborhood.
Right. Wall Street is discounting the house because the street is full of potholes, completely ignoring the fact that the house itself is practically minting money in the basement.
I like the analogy, but honestly, it's actually riskier than that.
Really? How
It's
so?
more like they're stripping the expensive copper wire out of their current house to fund the construction of a brand new experimental mega mansion next door.
Oh, wow.
Just look at Meta's capital expenditure burden. They are spending billions upon billions of dollars to buy NVIDIA chips and build out this AI infrastructure.
And in a normal, high interest rate environment, the market would brutally punish a company for bleeding that much cash.
Right. Usually Wall Street demands cost-cutting and austerity when a recession is looming
Exactly. But Meta is being treated as a safe haven. Why is that?
because they have an impenetrable competitive advantage, massive user scale, and an incredibly lucrative digital advertising platform.
Ah, so they're deploying AI right now to make their ad targeting so terrifyingly efficient that the immediate boost in ad revenue offsets the cost.
Exactly. The core business is funding the massive long-term AI pivot in real time.
And the companies supplying the materials for that pivot are seeing astronomical numbers too.
Oh, the hardware side of this boom is staggering. Look at ARM Holdings.
Right, they're making a massive pivot into the chip-making business for the first time with their ARM AGI CPU.
Yeah, which is specifically engineered for AI data centers.
Okay.
And this represents a fundamental shift in the entire semiconductor ecosystem.
Because historically, ARM hasn't actually manufactured chips, right?
No, they're an architecture company. They design the blueprints, the highly efficient instruction sets that tell a processor how to operate.
And then they license those blueprints to companies like Apple or Qualcomm.
Right. They sell the recipe, not the cake.
Well, I like that. But now, by stepping directly into manufacturing their own AGI CPU for data centers, they are trying to capture a vastly larger slice of the pie.
Exactly. They don't just want the licensing fee anymore. They want the revenue from the physical hardware that powers the whole AI revolution.
And their internal forecast is super aggressive. Project revenues could hit $25 billion by fiscal 2031.
Just think about the scale of the AI infrastructure build-out required to justify a single new product line pulling in $25 billion.
It forces you to ask a critical question. How much of this utopian AI future is already priced into the stock today?
It's a modern gold rush. And companies like ARM and NVIDIA are selling the most sophisticated picks and shovels ever invented.
We're even seeing this gold rush reshape global infrastructure on a geographical level. Like, Bitdeer just engaged DCI to finalize the development of Norway's largest AI data center.
Yeah, they are literally scouring the globe for specific climates.
Because of the heat, right?
It's all about thermodynamics. Training a massive neural network requires tens of thousands of GPUs running at maximum capacity.
Which generates a staggering amount of heat.
Right, so if you build a data center in Texas, you have to spend a fortune on electricity just to run the air conditioning to keep the servers from melting.
But if you build in Norway,
You get access to abundant, relatively cheap hydroelectric power, and you get ambient cold air for free cooling. You literally just open the vents.
that is wild. So while the traditional manufacturing economy is paralyzed by the rising cost of heating oil and shipping bottlenecks,
The tech economy is buying up energy grids near the Arctic Circle to train algorithms.
yeah,
It is a completely divergent reality.
it really is.
Yeah.
But, and this is a vital caveat, not all tech giants are immune to the physical world.
No, definitely not.
We just explored the AI acceleration, but we have to talk about the magnificent stumbles. Today's top losers clearly show a deep structural divide within the tech sector itself.
If a massive mistake to view big tech as a single monolith.
For sure. The biggest losers on the board today are Apple, Tesla, and Micron. Let's unpack Apple first, because their situation perfectly bridges the gap between the digital space and the struggling physical economy.
Yeah, Apple is in a really tough spot right now.
The research lays out 3 major hurdles that analysts believe could make Apple the worst performing Magnificent Seven stock all the way through 2030.
That is a brutal forecast.
It is, but the mechanics behind it are pretty sound. The 3 hurdles are iPhone market saturation, weakening market share in China, and severe regulatory threats to its app store.
Yeah, those are massive headwinds.
So looking at these factors, is Apple's struggle a fundamental lack of internal innovation, or are they just a high-profile casualty of the geopolitical friction we talked about earlier?
Well, it's a combination, but the geopolitical and regulatory factors are the real dead weight pulling them down.
Okay, let's look at market saturation mechanically.
Right. In the developed world, basically everyone who wants a premium smartphone already has one.
Yeah. And the upgrade cycle has stretched out from 2 years to, what, 4 or 5 years?
Exactly, because a phone from 2022 is largely identical to a phone from 2026.
Right. So to grow hardware revenue, you have to steal market share in emerging markets.
And China has been Apple's crucial growth engine for a decade. But right now, domestic Chinese competitors are surging.
Heavily aided by those exact U.S.-China trade tensions we mentioned earlier.
Yes. Chinese consumers are increasingly favoring domestic brands, partially out of national preference, and partially because U.S. tariffs make American goods a political target.
So the hardware growth engine is stalling out in Asia. But traditionally, Wall Street hasn't panicked because Apple relies on its services revenue, the App Store, to pick up the slack.
And that brings us to the third hurdle, regulation.
Ah, right.
Apple has essentially acted as a digital toll booth for the last decade. They take a 30% cut of almost every digital transaction that happens on an iPhone.
Which is basically a license to print money.
It was. But global regulators, particularly under the Digital Markets Act in Europe, are taking a sledgehammer to that toll booth.
They're forcing Apple to allow third-party app stores and alternative payment systems.
Exactly. And if developers can bypass Apple's payment system, Apple's highest margin, most reliable revenue stream dries up drastically.
So just as their physical hardware sales face geopolitical headwinds in the East, their digital software revenue faces regulatory headwinds in the West.
Which perfectly illustrates why they are so tethered to the political realities of the global market.
Man, that's tough. Which brings us to an incredibly fascinating contradiction today. Tesla.
Oh, Tesla's fascinating right now.
Market analysts are pointing out a stunning metric. Tesla stock has actually underperformed the broader NASDAQ index for 5 full years.
5 years of underperformance for a company that was once the undisputed darling of retail investors.
And it seems to be attributed entirely to the company failing to live up to the massive hype surrounding unsupervised FSD full self-driving.
Tesla is the ultimate case study in the battle between a hype-driven valuation and actual physical delivery metrics.
Because for years, Tesla wasn't priced as a car company.
No, it was priced as an autonomous software network that just happened to put its code on 4 wheels.
The valuation basically assumed a near-term future of robotaxis everywhere, generating limitless, high-margin software revenue.
Right. But the technological leap from supervised driving, where you still have to keep your hands on the wheel, to truly unsupervised, sleep in the back seat autonomy.
It's been vastly harder to achieve than promised.
Exactly. And as that unsupervised FSD timeline stretches further and further into the future, the market is aggressively repricing Tesla.
They are realizing, wait, we aren't holding a limitless AI software company. We're holding a traditional automotive manufacturer.
And automotive manufacturing is brutally capital-intensive, fiercely competitive, and completely vulnerable to the macroeconomic headwinds we discussed at the very beginning of this deep dive.
Right, because when the Fed keeps interest rates high to fight that 4.2% inflation, car loans become painfully expensive.
The monthly payment for a consumer skyrockets, which obviously crushes demand for physical vehicles.
But wait, here is where I get confused by the contradiction. Despite the stock underperforming for 5 years, and despite the FSD delays, the analyst estimates we're looking at today still show robust demand for the physical cars.
Yeah, they are expecting over 1.6 million unit deliveries annually.
Right. So if a company is successfully building and delivering 1.6 million vehicles a year, how is the stock struggling so badly?
Because the stock was priced for magic, and they're only delivering exceptional engineering.
Wow. Okay.
The underlying business of bending metal and selling electric vehicles is operating at a massive scale. I mean, 1.6 million units is a phenomenal achievement in a high-interest rate environment.
But when your stock price assumes you will invent a world-changing AI software network and you, quote-unquote, only deliver 1.6 million great cars,
The valuation collapses.
you're basically being punished for passing the final exam because everyone expected you to invent an entirely new subject.
Exactly.
Yeah.
It shows exactly how unforgiving the market is right now. If you are a tech company that has to touch the physical world, like Apple manufacturing iPhones in China or Tesla manufacturing heavy vehicles that require consumer loans,
You are subject to the brakes of the economy, inflation, interest rates, tariffs, and shrinking consumer budgets.
right. But if you are operating primarily in the digital AI infrastructure space, insulated from those physical supply chains, you are slamming on the gas.
Which brings us entirely full circle.
It really does.
As we step back and look at the totality of today's deep dive, the market is defined by a stark, almost unprecedented divergence. On one side, you have the everyday reality you live in. Inflation is sticky, Global oil shocks are driving up the cost of your delivery apps, and the Federal Reserve is heavily favored to keep rates high.
Making mortgages and car loans brutally expensive.
And on the other side of the glass, an unstoppable AI revolution is creating an entirely separate, booming economy.
Tech giants are pouring billions into data centers in the Arctic, completely insulated, at least for now, from the struggles of the physical world.
It leaves us with a lingering question, something to really chew on as you review your own portfolio or just look at the world around you.
What's that?
Well, if AI infrastructure companies like ARM are projecting tens of billions in new revenue, and the digital economy continues to accelerate at light speed, while the fundamental physical economy of shipping, food delivery, and manufacturing slows to a crawl under the weight of inflation, what happens when those two worlds completely detach?
Yeah.
Can a society actually function, let alone thrive, when the server farms are printing unprecedented wealth, but everyday people can't even afford the delivery fee for their groceries?
I mean, that is the defining structural question of this decade.
And it is one we are going to keep tracking closely. Thank you for joining us on today's deep dive. Remember to keep questioning the consensus, look past the headlines. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.